Good afternoon, and thank you for joining the Women in Innovation Building Success webinar. Today we'll be discussing financial planning with my colleagues Fadlon and Charlotte Thompson. Just before we begin, I'll just run through a couple of key points for you. So you will have noticed that when you come on, you have all been muted and you'll remain muted throughout the webinar. However, there will be a Q&A session at the end of the webinar. If you have any questions, please type them into the Q&A box. If there's anything that you'd like to discuss or you're having any technical problems, please put them in the chat box and I will address this as we go through. The webinar is being recorded and will be made available as well as the slides following the webinar in the next day or two, and you'll receive an email with all the details sent to you. So with no further ado, I'm going to hand over to my colleagues Emma and Charlotte, who will take you through today's webinar.
Hello and welcome everybody. As Siwan introduced, this seminar is around financial planning, and what we want to do is introduce to you why it's important to really know your figures inside out. It doesn't matter if you're just starting up a business or whether you're quite established. It's really quite important that you get this right from the very beginning. So by way of introduction, my name is Emma Fadlon. I'm on the Access to Funding and Finance team, and I work with early stage companies to help get them funding and investment ready. I'll hand over to Charlotte to introduce herself.
Yeah, I'm Charlotte Thompson. I have a very similar role to Emma in the Access to Funding and Finance team at the Knowledge Transfer Network.
Okay, so moving on to our first slide, and this is really about why. Why do we think this is important, and why is this part of your seminar program? Well, firstly, for those of you who are actually directors of the companies that you're engaged with, it is a legal requirement to post your accounts. It's got to be done on time and with Companies House. Then you've got to start thinking about a new business. When you're setting up, you've got a lot of different things to do and to prioritize, and you have to make sure that all the activities you're doing are working under a tight budget. And people also often overlook how important their accounting history is and financial planning is, because later down the line it is part of a due diligence process, which we'll discuss. And one of the common mistakes I see with early stage companies is that they don't establish a robust financial reporting structure at the very start, and they usually put off by doing this because they think it's really difficult. And actually, when you begin, it doesn't have to be difficult. It doesn't have to be complicated. There are a lot of sort of things out there to help you, and we'll sort of talk about that. So as we've discussed, why is it important? Well, you actually have a legal requirement to post your accounts in Companies House. This becomes a matter of public record, and anybody can go and look and access those accounts. And I would very much recommend that you go and have a look at Companies House, choose a company that might be similar to you, and have a look at how the accounts are reported and what the structures are for the financial information shared. Investors also look at your accounts, and what they're looking for is profitability and when they're likely to see a return on investment and how that's linked to the business plan that you present. Customers also will look at your accounts, and as we said later on, we'll discuss how that can affect you. And that's really because they need to know that you've got enough cash in the bank to be able to deliver on the service that they're procuring from you. And also, as a director, you need to have enough money in the bank to pay your staff and suppliers. You need to have a minimum of 3 months worth of money. Otherwise, you do actually have to fold the company. So if you're not aware of what your liabilities and what your responsibilities as a director, do go and have a look at the government websites and learn about this, because it is very important when you start up and is often overlooked. So what are the learning outcomes from this webinar? Well, basically, we want to give you some basic tools to understand about how to go and build your financial model, understand some of the basic reporting requirements that you'll be expected to provide, and signpost you to some of the resources that are available. And now I'm going to hand over to my colleague, Charlotte.
So as a director, your role is to set out that long-term strategy for the company. and to promote the vision and company successes, not only to your team, but also to external stakeholders. It's also the role of the director to ensure that there is enough cash to employ people and deliver on that plan. And that cash can be from sales, but also by attracting new funds from equity investment, debt finance and grants. And actually there was a recording that Emma and I did a couple of weeks ago that talks about the different forms of funding, and you can access that recording online on the KTM website. Also, as a director, you need to consider what risks and opportunities that might arise and plan to deal with these. And it's also your role to manage not only your personal interests and the company interests, but also other businesses, peoples or entities that you have a relationship with that might be affected by the company's business. And this is certainly the case with spin-outs, where you are still associated with a parent company and organisation. So a good starting point is your business plan, or at least the business model canvas. It does not need to be hundreds of pages, but it should be clear and concise in describing your business model. And it's this initial model, which will no doubt change as your company progresses and you raise more money. So ways that your business model might change is the company might change from moving from a consultancy to a software as a service model, or even from carrying out research and development to a contract research and license model. And getting this framework right helps develop your financial plan. So the associated financials are linked to your current status as a business. How long have you been trading? And if you have made any sales, which will dictate how much detail and percentage of certainty you can ascribe to each activity. And as an early stage company, consider what you realistically can predict and what is an estimate. So I think it's good to develop a 3 to 5 year financial plan based on the activities that you have laid out. And this should be detailed for the first 12 to 18 months and then quarterly thereafter. By mapping out the activities with costs and sales, it'll be easier to see when you need more cash and how much, and this will help you look at external forms of finance to support your growth. Equally, understanding when you will realise profits is important for your shareholders and when an investor will get that return on their investment, and this will help build the case for attracting external funds. So if you've never built a plan before, don't worry, there are lots of free resources, and we will share a resources fact sheet with some of these links to some of these sites after the presentation. So I'm just going to hand over now to Emma to talk on the financial plans.
Okay, so what is the basic information that you need to sort of consider? Well, there were used to say 3, but I'd say there are now 4 basic requirements in the UK. You need to have your early stage accounting. That's what we would call management accounts. So that's how your business is going to operate and run. There's a bookkeeping. So think about, sort of managing your all your expenses, any invoices, purchases, etc. There's understanding your taxes. And now as well, there's an obligation to have a staff pension scheme, and you do need to make sure that you're compliant. So it's really important as well under tax, if you're an R&D active company, to consider your R&D tax credits. Now, why do we think that's important? Well, it's actually money back to you, and you can put that back into your business. The incentives are good and looks like they might be getting better. And it's really also important for some businesses because your year end can be linked to when you're likely to get your R&D tax credit cash in. So some people actually use that as a reporting point for the year end of their accounts. If you're unaware of that, there's some very useful help online as well around R&D tax schemes and how they operate. So you're looking to raise finance from grants, equity investments and loans, then you are really going to need to have a detailed financial plan in place for all of the obvious reasons. If you are looking to raise grants, debt finance or investment, you need to be able to link that to your business plan. And really what you're looking for in the business plan is the supplementary information section, which is when are you going to need that money? How are you going to get it? What are your plan to go out there? And also what terms and conditions are associated with those. So with debt finance, there's repayments, there's sort of penalties. If it's a convertible loan. There might be some issues around you have to manage around what the share prices will be and the options in the future. And the same goes for investment. And also with grants. With grants, you commonly offer innovation products, but they do require match funding if they come from the Innovate UK. But they do vary, and it depends on which government department or scheme you're getting the grants from and from charities. When you're applying for these grants, you often have to put quite a detailed financial plan in place, and that has to link to your business plan. And some of the debt finance will want to look at all of your business plan and will also look retrospectively on accounts you filed. Factoring is also an approach to get cash against a guaranteed purchase order. And basically what you're doing is selling your invoice at a discount. You do get the cash immediately, but obviously you're not going to get as much money because you're selling that away. Somebody needs to make a profit. Those will all require you to have a very robust business plan. So what do you need to do when you're think about this? Well, you need to think about projections and your financial projections and use a really sensible model. It doesn't have to be sophisticated. Don't discount risk, but don't be too pessimistic around that. It's usually good to sort of cross-reference your operational plans to your research and development plans, any legal fees you may have around IP and IP rights, any marketing costs, any sales costs, warehousing, and fulfillment costs as well. So if you've got sales, you could use a discounted cash flow model, but please don't use that model if you've not made any sales and you're still operating effectively on investment that's coming into the business. So for tech businesses, when you're projecting your financials, I would really suggest that you look for something, a model 3 to 5 years. You're maybe starting as sort of a consultancy software as a service model and moving on to software as a service with subscriptions. And you'll know what your contract periods are, what your retention rates are of customers, and you can start building quite a robust model out around that. You'll also know what the cost of acquisition is, and therefore what your profit is going to be to when you link it to the cost to maintain the software and the service. When you're research intensive or you're very high capex, so let's talk about pharma, industrial biotechnology, and some agri-tech, there are going to be some long-term investments required. And though you'll still do a model for 3 to 5 years, you're probably still going to be running in debt, i.e. needing equity investment. So your projections really need to show what your milestones are and when you need that cash injection. Irrespective, you should all be able to give a robust sort of monthly burn rate for the first 12 to 18 months of your business, depending on how much money you've got. And thinking about the longer term quarterly estimates, as I've said, make sure that you take into account all of the extras that are going to be tagged on and the hidden extras such as insurance and legals that would come along. Projections, what we're looking for and what investors would be looking for is something that's realistic in between values. So not the best case scenario where everything goes swimmingly and you raise all the investment and you meet all your milestones, but also not the most pessimistic that everything takes a long time. So somewhere sort of sensible and in the middle that you're comfortable defending and you can actually evidence. Obviously, if you're going to make any projections, then you're going to have to make assumptions. And what you need to think about is what model it is that you're going to use to do that. And this is where your industry research is really important. So in your business plan or business model canvas, you would have done a competitor analysis. You would have looked at what unique selling points. You would have also understood how these businesses reach their market or engage with their market. So use that to think about your sales cycles, what product offering you're going to be, what the turnkey solution is going to look like, and then make the assumptions about how long it's going to take you to reach the customer, deliver the product or service, and then see the income coming in from that sale or collaboration. Really, at an early stage, suggest that you look at companies to benchmark against. And we're very lucky in the UK because you can go back to Companies House, look at people's accounts and see how they've grown the business. There are paid for database services like Bowhurst, which are also very useful and track UK companies. And the other thing that I think is very important for you to remember is that it's okay to pivot. It's expected in early stage companies and technologies, and quite often it's driven by standards, regulation, market opportunity, collaborations. You could have had an unexpected technology milestone, which allows you to operate in a different market space. And then there's funding and finance opportunities, and you do have to follow the money. Where it does become a little bit more complicated is if you're a disruptive technology and you don't have a direct sort of comparator in the marketplace. In that case, what I would suggest is you break it down into comparable components on the service or the product delivery, and think about what you can compare and how you'd be delivering that. We also suggest that if you are really truly disruptive, you're putting in a new business model and process, that you work with an accountant with sector expertise who can help you build that model, and they can have some very useful insights. So we're now going to move on to what is actually in the finance pack. Well, the finance pack is actually really 3 sets of information. You will have the income statement, a balance sheet, and the cash flow. And an investor will want to see all of this information, and you will be putting, as a small company, early stage, you'll be putting an amalgamation of this up onto Companies House. So what's in your income statement? Well, an income statement effectively is your profit and loss statement. It's what the numbers and the money you've got that you're working with. It shows whether you're profitable, or if you're running on investment, when you are likely to become profitable. Even though you're pre-revenue, investors and collaborators who may need to see your accounts for various legal reasons, they will still want to understand what your current finances are, what your monthly burn rate is, and what your future funding requirements are. And that's really sort of to have a feeling and understanding of where you are at any particular moment in time. Next, we're talking about the balance sheet. So this is a list of your assets and your liabilities. It gives a snapshot of your financial position at that given time, and it must balance. So your assets and liabilities must balance. There are numerous subcategories that you need to account for in a balance sheet, and examples of assets is cash that you hold, accounts receivable, so that's money that's owed to you, any inventory and equipment that you have. And liabilities are accounts payable, so those are fees that you owe to other people, salaries, any taxes that you owe, rent, utilities, and any loan balances you may have. Now, from the very beginning, I would say think about how you're going to start recording all of these components and what their values are. Do you have an asset register for your equipment, like computers? Do you know what depreciation model you're going to use? And these are all quite important because they also fit in when you're going to try and claim your R&D tax credits, or if you're trying to get a really robust balance sheet together. There are some anomalies on assets which may not decrease in value over time, even though they might do in the real world. And that's things like property assets. So you may have a house or a building that you're operating out on that you own, and actually that has to decrease in value on the balance sheet, even though it doesn't in real terms. Land is one thing that does remain at the original cost on a balance sheet. But again, if you have got property and land that's associated with your business, I would suggest you sort of engage an accountant on how you're going to manage your balance sheet as you go forward. Next, we're going to talk about the cash flow statement. So this basically tells me about what monies you expect to come in and what monies you expect to go out. If you haven't got any sales, then it's about predicted cash flow. So it could be revenue that comes in through milestone payments from investors. It could be grant money that you're given in arrears or that you're given up front, depending on the type of grant you're getting. If you have sales, think about your forecasts, when receipts will come in, the time that it takes to collect the accounts that are receivable. And if you've got business expenses, you need to think about how and when they're paid. So you may have trade credit, you may have an invoice schedule. How do you pay your suppliers? So those sort of things need to be built in, because they'll determine how much money you're going to have at any one point in time. And what you want to do is to smooth out your cash flow so you don't have sort of deficits and big sort of peaks and troughs with things that are coming through. So for a startup, building a cash flow model is probably quite simple. You will probably have very little money coming in. It might be investment and you're spending more. It could be some grants. But what it is, it's a very, very good way for you to keep a track and set your business goals. And it's a really good idea to start sort of thinking about managing and looking at your cash flow model from the very beginning. And obviously it's board meetings, it's a report, something you report against. It also helps keep you financially viable, and you can use this to establish goals. So when do you need that next injection of money? So when do you need to start going out fundraising or speak to your investors for follow-on investment? And it can also be very, very useful to sort of understand what the risks are in your business and what sort of grants, collaborations you might want to get engaged with, because the sales cycles may be such that they take too long and you're running out of cash as a business. So it's a really useful tool as an early stage company. I also suggest that you go to Companies House, as we've said before, and download some of the historical financial reports from competitors as a guide, so you can see what sort of experiences they've had and how that sort of looks in context of their cash flows over time. If you're an established company, then its cash flow modeling can be a lot easier. You may have recurring revenues, and investors love recurring revenues, because if you're signing somebody into a contract and they're paying every month or every quarter, then you know you're going to have quite a smooth cash flow into the business. But it depends how established you are. And if you're planning for growth, so you're at the scale-up stage in your business, then you need to think about how much money you want to have, how that's going to be reflected in the scaling up of your business, and have you got enough to deliver and enough to pay for the people, for the goods, the materials, and the scale-up plans. You can use your existing financial data. And if you are making sales and you want to use a model such as a discounted cash flow modeling, that's the time when you can use it, because you've actually got some real numbers of which to make the projections. And then it's a lot easier to sort of project forward for 5 to 10 years. And that's what you typically see in the standard accountancy examples. So I'm now moving on and passing over to Charlotte, who is going to explain to you when are all these financial statements used.
So I'm going to go into who else will you be sharing this information with. So next slide. And firstly, we'll go talk about investors. So if you're inexperienced in preparing these statements, it's worth hiring an accountant to help you, because you often only get one opportunity to make an impression with investors. So it's better to engage with an accountant than losing that credibility and that investment. And ask a professional or experienced investor to give you an unbiased second opinion on whether your investment business plans and projections are realistic. Another stakeholder is financial institutions. So financial institutions will make a judgment on your business and any commercial assumptions you have made. And remember, they will often know the sector and trends that you are in. It's worth writing down the assumptions you have made in your modelling and referencing the evidence you have gathered. They will be wanting to understand your business and what plans you have for the future, and establish the risk in providing a loan and at what interest and when the loan will be paid back. And then from the customer's perspective, they'll be making a judgment on your company's viability. They will want to be able to see that you'll be able to deliver on the contract, and what are the risks if you run out of money, and how does that need to be managed in any legal documentation and contract. On some tenders, you may also be requested to provide detail from your accounts and some tenders require certain levels of turnover and years of business in order to be eligible to participate. So make sure you read through all the T's and C's. Now, if you're looking to raise funding from public sector sources in the UK and EU, some are bound by state aid rules and undertaking in difficulty. It's worth working with an accountant to make sure that you do not fall under this category. You may need to manage any loans by converting this to equity, or have to go out and raise more equity investment to ensure that you're eligible to receive these grants. Now, there are lots of useful resources online for financial templates and options from your local growth hub, devolved authorities, the Institute of Directors and the British Business Bank, and many more. And it's also worth looking out for new software models that can help you support basic accounting requirements and make this less of a burden. And we will share some of these online resources with you afterwards. So that's it from me and Emma. Does anyone have any questions?
Thanks, Charlotte. Thanks, Emma.
Can I just add something, Shiwan, before we move to Q&A? For those of you who have started companies and you may have a board, I'd really recommend that you try and find yourself a mentor or somebody on the board or an investor who comes from a financial background, and they can work with you and help you in building your model and testing your assumptions and be kind of your critical friend. And you'll actually find that some investors will do that ahead of investing in you or introducing you to their angel groups and networks, because they want to help you get it right and get you in the right footing. So don't be shy and do ask.
Great.
So if anyone's got any questions, please type them into the Q&A box and I'll read them out. First question now is, when presenting your financial information at, say, a pitch event, how much financial information should you present and how accurate should that be?
It depends on the event you're at and the time you've got to speak and the audience. So if you're going to an angel event and you are going and you may have software as a service model, you may have some customers, you may have some modeling that you've done, you actually want to have some quite detailed finances. They'll probably want you to talk about your first 12 months, your historical last 12 months, and they will want to then see how that tags on to your third, fifth year and when you project to be in profit as a business. If you're in a pitching event and you've got a short pitch, 5 minutes, 10 minutes, it's in a public domain, you may be asked to give no finances or very, very high level finances, where basically you're saying, this is how much money we're going to spend, this is how much money we need to raise, and this is how long it's going to last us, and this is where we need the next investment round coming in. So it's actually very, very high level, and it's only when they do the due diligence on you that they'll start interrogating the figures. For those of you who've got digital models and subscription models, it's really important that you know what the cost is to acquire a customer, what the retention time is likely to be, and what the profit is going to be per customer. Those are the sorts of levels of questions you get asked, actually, even at the smaller pitching events. Some pitching events you may be asked not to include any financials at all, because they don't guarantee that the people in the room are high net worth individuals or sophisticated investors, and there's some issues around that. Anything else to add, Charlotte?
That was really well articulated. I think we often also find about the stage of a business. So, you know, at an earlier stage, yes, you might only expect to see up to 3 years, but for a more established business, definitely 5. I think
the pitching.
There was also a piece that was mentioned about how accurate it needs to be, and it's not down to the decimal place. It needs to be, depending on how much, it's down to the 10th or 100th of a pound. Because if you're projecting for 3 years in advance, I think it's a bit unrealistic to know down to the pound what you'll be spending.
Is there a difference in the financial information that you present and emphasize between grant applications and investment?
So for a grant, more often than not, they'll be looking to understand your finances for example, an innovation project, depending on what the grant is. Whereas for investment, it will be considering what the finances are for the innovation project and the business finances. And depending on the business, there will probably be differences between those.
And it's worth remembering that when investors do due diligence, they will be looking at all the supporting contracts and relationships, any terms and conditions. They might even look down to what fees you're paying it for certain goods and services and legal fees and how much you're spending on that. And they will question that. So they will start really sort of burrowing into that, which is why I said, you've got lots of different subcategories, capture them all. Also, when you're going for R&D tax credits and you want that money back, the more information you keep and the better you divide it all up and articulate it, the easier it is to see how much R&D tax credit you're entitled to. Most people underestimate what they're eligible for because they don't actually build the right financial reporting model and structure for their projects and for their business. So they miss that opportunity of claiming money back from the government.
And is there some more basic sources or resources where one can work through the stages following this webinar?
Yes, the websites we're going to send you, the government one, they have template documents which were done, I think, by the Prince's Trust on there. You will have, ICOR has some links and resources as well. And you will also see various guidelines from Companies House. The government's done quite a lot of good resources. For those of you who are considering startup loans, which is individual loans to you as directors, you actually get 6 months worth of mentoring, which will include financial mentoring as well. So if you are thinking of getting any loans, then I would definitely think about a director's loan because the amount of money is quite significant. It's patient capital, low interest rate, and it's managed by giving you lots of business support, including financial support.
And the templates online are really good as well. There's a cash flow forecast and business plan template on their website as well, startuploans.co.uk.
So
all business, but those are all British Business Bank products, which we were talking about.
And we'll circulate the list of resources with the webinar recording afterwards as well. So another question, what or who is needed for early stage accounting and who is this needed for?
Sorry, could you say that again? I missed that.
What or who is needed for early stage accounting, and then who is the early stage accounting needed for?
Well, you have to put your accounts into Companies House annually. So you as a director are responsible for these early stage accounts and making sure you post in time, otherwise there's a financial penalty.
Do you need a chief financial officer at that point, or is just the director okay?
It's anybody who is financially competent who can do that for you. It's as long as you put that in. When you go further down the line and your business gets more complicated, you may want to have somebody in to bring in as the role. Quite typically with an early stage company, you'll have somebody who will pick that up and work with a bookkeeper or an accountant just to make sure that everything is reported properly. It really depends on the sort of business you are and how much money you're bringing in and how much investment and how much reporting requirements you get from those investors or those parties as well. But it should be very easy at the beginning to set something up very simply. And there's a lot of resources to help you because they don't want you spending a lot of money unnecessarily. Some accountancy firms will do it as a risk, discounted rates as a risk reward, because they see that when you become more successful and you need more support, they will get your business. And they also have high net worth individuals that they can introduce you to as well as your business grows. So you'll see offers from firms such as Grant Thornton's and some of the other big UK and international accountancy firms, as well as the local accountancy firms. So it's worth shopping around for what service you get and what support at what price.
I'm not got any more questions at the moment, but if anyone has any questions, please do put them in now. Emma, Charlotte, is there anything else that you think our delegates might need to know about financial planning?
I would say that it's not as complicated as it sounds. It's not frightening. Remember that there are two types of accounts. You've got your bookkeeping accounts, which is the easy stuff. And then you've got your management accounts, which is thinking about what the business needs for the future and how that fits in with all your activities. I would say start off with planning out all the different activities, all the different resources, and all the different costs for your business, and put them all out there, put them in a nice sort of format on paper where you can see it, and then just work from each of those and then build it up slowly. You know, just break it down into really bite-sized chunks of information and start recording against all of that. And even if you change the headings and how it is, if you start off with an Excel spreadsheet with all of that information, it's so much easier than leaving it to the last moment and then scrabbling around trying to find things. And, you know, for the simple accountancy, bookkeeping things, just try and find the digital tools. Sage has now went open its platform for APIs. So a lot of the companies have developed some really clever little accountancy tools. I've seen everything from things that have been designed for beauticians who are mobile through to, you know, businesses and receipts and management, you know, with quite large sort of significant number of mobile staff. So there's lots of very cheap and easy to use products out there to help simplify things for you.
Brilliant. So we've got one last question, which I think you may have mentioned before. Do you have templates for cash flow and financial indicators that we can share?
So we'll send around some links to resources on some of those sites. You'll be able to find some templates, and we don't have one that we from the knowledge transfer network that we use, but there are plenty online that we will share it after the webinar.
One of the things I would say is that you've got a lot of regional business support services. So if you've not engaged with your local enterprise partnership, your local Chamber of Commerce, your local Enterprise Europe network, then do so, because they all have various sort of support mechanisms for you, which will include some or all of these elements. They can help with your financial planning and overview. Your local Chamber of Commerce might even have some small grants and sort of regional and business support. And don't be afraid to ask for help. You'll be surprised how many people are out there who are flat and are very happy to help you set up and review some basic financial modeling. There's lots of retired and semi-retired sort of angel investors who are really, really open to helping you. So do work your networks.
Okay, so I've got one other question. What if the business isn't successful and you make a loss by the end of the financial year?
Well, you've got certain issues. So you can't operate a business where you can't pay off your assets and liabilities. You have to wind that down. If you don't do things properly as a director, you'll be struck off. You won't be able to be a director again for 7 years, I think it is. So what you need to be very, very clear on how you manage your cash flows. However, if you can pay off the debts, you're sort of cash neutral, then you can hold that company, you know, for as long as you want in company's house and just file your annual accounts, and that's fine. But if it looks at any point that within 3 months to the end you can't make ends meet, then you really do need to wind that company down or get advice about how you can get some more cash in. You actually have a legal responsibility as a director. It's not our job to advise you on this. It's not an area I'm an expert in, but you have to be aware of your financial responsibilities as a director. And that's where your board comes in, because they should be looking at your accounts on a monthly basis and planning for any risks and any issues. And you may, if you've got investors, they may be willing to put in some bridging investment while you try and sort things out or rejiggle things. You couldn't renegotiate your payment terms so that you can manage that while you're waiting for the finance and funding to come in. But you shouldn't be in that position. You should have been aware of that several months beforehand, mitigated that risk, and wound the company down and paid off all your debts before that happens.
Okay, I've got no further questions, so I'm going to say thank you very much to sorry, I've got one more question that's just come in. So it says, you've talked about the importance of the board to guide you. What about if you are a micro enterprise?
As a micro enterprise, you can still look to build a board or advisors to support you, and it's a great way of extending your small team into a much bigger team by working your networks. And like Emma said, a lot of people are willing to meet for a cuppa and talk things through as a mentor and provide that guidance. So regardless of your stage of development, you can look to build that board.
I would absolutely I can't emphasize enough how useful it is to get a friendly advisor or person who will help you and who you can talk to, because there are so many caveats, there's so many things. You're going to be dealing with so many different issues around just the technology development or the business growth, and actually having somebody you can go back to and talk to about things like this, which are, you know, absolutely legally essential, but actually can be quite complex if you're not familiar with the terminology and the methodologies that are associated with accounting. Just get that help. You'll be surprised how many people are out there and willing to help you.
Okay, thank you both, Emma and Charlotte. That's been brilliant. Emma, can I just ask you to move the slides on one, please?
Yes, let me do that.
Two then, sorry. Thank you very much. So this is now the end of this webinar. Thank you very much for joining us today. We have two further webinars coming up in the new year. So we've got one on expanding your horizons, which is looking at a range of different opportunities that may be relevant for your business, and that's on the 7th of January. And then we've got one on the 14th of January covering value proposition. We'd encourage everybody to join our newsletter. The link is there, and it's the Women in Innovation newsletter, or our online community. Again, the link is shown there. If you have any questions about the Women in Innovation program or would like further support from KTN, you can feel free to email me, and my email address is there. So it's shuan.smith@ktn-uk.org. So thank you all again for joining us, and this is now the end of the webinar. We'll hopefully see you again in the new year.
Thanks, Joanne.
Thanks.
Bye, everyone. Good luck.